Okay, so welcome back. We will continue with the topics. We were doing target costing and we have completed the first question in target costing. Okay, now we will move to the question number 4.2, that is in page number 6. So first read the question number 4.2. Okay, now we will read the question once again. Stockwell Industries Limited manufactures standard heavy duty steel storage racks for industrial use. So the name of the company is Stockwell Industries Limited. Stockwell Industries Limited. This company is manufacturing heavy duty steel storage rack for industrial use. So steel racks for industrial use. Then each storage rack is sold at rupees 750 each. So the selling price per unit is rupees 750 for each rack. The company produces 10,000 racks per annum. So annual production is 10,000 units. Then cost component, you have the budget, then you have the actuals and actual cost. Okay, first is the direct material. Direct material, it is given in square feet, like 5 lakh square feet and 5,20,000 square feet, and the actual cost is also available. Then direct labor 90,000 hours and 1 lakh hours is the actual hours, and the actual cost is 10 lakh. Machine setup 15,000 hours, then actuals also 15,000 hours, and the cost was 1,50,000. Okay, then machine assembly 2 lakh hours was the budgeted, actuals also 2 lakh hours, and actual cost was 30 lakhs. The actual and budgeted operating levels are the same, which means what? The budgeted production is equal to actual production, right? Budgeted production is equal to actual production. Okay. Actual and standard rates for material procurement and hourly labor rate are also the same. We'll underline this. Actual and standard rates for material procurement and hourly labor rate. That means the actual rate is equal to standard rate for two things. What all are they? Material procurement. So material purchase rates. Also what? Hourly labor rate. That means labor rate. This is per unit and this is per hour. Okay, so in the case of material as well as in the case of labor, there is no difference in the the rate per hour in case of labor as per the standard and actual, and also in case of material, the price per unit in case of actual as well as standard. Okay, so any variance in cost is like solely on account of difference in material usage and hours required to complete the production. I think this point is clear to you, right? Material material cost, we have both actual as well as standard. Okay, what is the actual material cost? Actual material cost is 20 lakhs. Okay, whereas standard rate is not available. Okay, but what you have here is material usage is given. Material usage. Okay, material usage is budget is 5 lakh square feet, but actually is 5 lakh 20,000 square feet. So there is a difference of 20,000 square feet. Okay, and here now the information says actual and standard rates of material procurement and hourly labor rates are same. So there is a material usage variance, but material purchase price, okay, this will be same as per both actual as well as standard. These are same, which means any variance on account of materials will be purely on account of material usage itself, not on account of material purchase. Similarly, in the case of labor, labor cost actually is given. We don't know what is the standard, what is the actual labor cost, 10 lakh. Okay, what is the formula for actual labor cost? It is labor hours consumed multiplied by direct labor rate. They say that there is no change in labor rate. So the only variance in labor cost will be only on account of the labor hours consumed. And labor hours consumed, it is different. Budget it was 90,000, whereas in the actuals it is 1 lakh. Okay, so that is to interpret the questions. Okay, now this is okay. Then any variance in cost is only on account of difference in material usage and hours required to complete the production. Aggressive pricing from competitors have driven the sales down. Now competitors are coming and competitors are pricing the competitive goods or the other goods in a competitive manner. So the sales of the company is coming down. A comparable rack is available in the market for rupees 675 each. Okay. Now here this rack is sold at what rate? This rack is sold at 750 per unit. Am I right? 750 per unit. Whereas a comparable rack is available in the market at a rate of rupees 675. Vishal, the marketing manager, has determined that in order to maintain the company's existing market share of 10,000 racks, Stowell Industries must reduce the price of each rack to 675. So you are required to calculate one, calculate the current cost and profit per unit, identify the non-value added activities in the production process. Two, calculate new target cost per unit for a sales price of rupees 675 if the profit per unit is maintained, and recommend the strategy the company should adopt to attain the target cost calculated in step number 2 above. Okay, now we will go ahead. So the first part will be what? First calculation is you need to compute the current cost and profit per unit. So 1 current cost and profit per unit. Current cost and profit per unit. Okay, how to compute this? Now you have to take the cost components. Cost components. Then quantity. First we will take actual data, figures in rupees, and actuals per unit, again rupees. Okay, so first is total revenue. Well, I will write it as sales revenue. Quantity, they are saying that both budgeted as well as both production as well as sales is 10,000. Okay, 10,000 racks or units. What is the total sales amount? It will be 750 per unit. So this will be 75 lakhs and actual here will be 750 per unit. Okay, now less direct material. What is the cost they are seeing? It is 5,20,000 square feet. Okay, and actual cost is given to be 20 lakhs. So per unit will be 20 lakhs divided by 10,000. Okay, so actual this is for okay, so divided by 20 will be 10,000 will be 200 here. Then what else? Less direct labor. Direct labor, you have consumed 1 lakh hours. And what is the cost? Cost is 10 lakhs. Okay, if you divide it by 10,000, you will get 100 per unit. Then you have machine setup. Machine setup. Machine setup, they say for setting up the machine, the company has taken 15,000 hours and the total cost is 1,50,000 rupees. Divided by 10,000 will be 15 rupees per unit. Okay, then less, what is this? Mechanical assembly. Mechanical assembly, how much? You have 2 lakh hours. Okay, the cost will be 30 lakhs divided by 10,000 will be 300. So total cost per unit 200 plus 300, 600, 615, 615. Okay, then total cost here it will be 61 lakh 50,000. Therefore profit. Profit will be 75 lakhs minus 61 lakh 50,000 will give you 13 lakh 50,000. This will be 135. Is it clear? Okay. So it means that the current cost, what are you required to calculate? You are required to calculate the current cost. The current cost per unit is equal to rupees 615 per lakh, and current profit per unit will be rupees 135 per lakh. Okay, so this is the computation. Now what is the second part of first question, that is identify non-value added activities in the production process. Okay, what are the activities given in the production process? You have something called direct material component. Do you think that this material does not add any value addition? It is definitely value adding. Then similarly you have direct labor. Is it value adding? Not value adding. It is also value adding. Okay, next is machine setup. Do you think that machine setup is adding any value to the entire activity? No. Machine setup is required, is the time required to make the machine ready for the production, and this per se does not add any value to what the production process, though it is very much essential. It does not add any value. Okay, even if you can avoid this machine setup, provided you have a technology, that is well and good. Okay, so machine setup generally taken as no value added. What about machine assembly? Mechanical assembly. Just because you have the components, that will not give you the final product. You need to assemble it, and that is assembled using the machine. So it is also a value added activity. So you can write out of the listed activities, the time taken, the machine setup time, that is time taken for setting up the machine for production, is a known value added activity. Okay, so that should be your conclusion. Now moving further, what is the next part? Next part is calculate the new target cost per unit for a sale price of 675 if the profit per unit is maintained. So computation of target cost per unit. Okay, how do you compute? You have the given selling price. Selling price per unit is 675 plus required profit. What do they talk about the profit? They say that if the profit per unit is maintained, it should be maintained. So what is the present profit per unit? It is 175. Okay, it is 175. Am I right? It's 135, not 175, 135. So it is 170, 135. So that means the target cost, or the cost at which the product should be produced, will be 540 per unit. Okay. Then what is the next question? Sub question. If the prices recommended, what strategy Stockwell industry should adopt to attain target cost calculated in step 2 above? So cost reduction required is equal to actual cost has to be brought down to target cost. So actual cost per unit minus target cost per unit, that will be actual cost is how much we have already computed it to be 615. Okay, and target cost is 540. So reduction required is 75 per unit or per rack. Is it clear? So that is the cost reduction required. Now what is the next part? You need to suggest on the strategies to be adopted to attain the target cost. Strategies to be adopted to obtain the target cost. Okay. Reduction in price, not in price, the cost. Reduction in cost required. What is the cost reduction? That is 75 per unit. Okay. Now what is the first strategy? We have already identified one non-value added activity. Okay. So why don't you suggest to eliminate it completely? Because non-value added activity is not required for or is not adding any value to the output. So the machine setup time, what is currently incurred, if it can be avoided, then the cost can be saved. Okay. So you can write the machine setup time 15,000 hours, cost a sum of rupees 15 per unit. Okay, this is a non-value added activity. This is a non-value added activity. The company may look for eliminating this NVA and save rupees 15 per unit. Okay, so after eliminating this NVA, the further reduction in cost, further reduction in cost per unit required. Total requirement was how much? Total requirement was you have to reduce 75. Out of that 15 is reduced. So 75 minus 15, let me give you rupees 60 per unit. Okay, 60 per unit. Now what is the second possibility? Now if you see the question, you can see that almost out of what is the total cost is 615. Out of that, almost 50% of the cost is on account of machine assembly. Machine assembly is a value added activity, but the amount incurred for that value added activity is very high. So what you can do, you can think of methods to reduce the cost in the value added activity. Okay, so you can write mechanical assembly is a value added activity, hence it cannot be eliminated. However, the company may exercise cost reduction strategies to reduce the mechanical assembly cost at least by rupees. Okay, therefore required minimum percentage of cost reduction in mechanical assembly is equal to, you need to reduce 60 rupee out of how much? 60 rupee out of 300, am I right? So that is equal to 20%. So if you can reduce the cost of mechanical assembly by 20%, you can reach the actual cost. You can make the actual cost equal to the target cost. Okay, therefore company may look for reducing the mechanical assembly cost at least by rupees 60 per unit. Okay, the company may employ various cost reduction strategies such as value chain analysis, then value, then Kaizen costing, value engineering, etc. Clear? Okay. So these are the methods in which they can reduce the cost. Now we need to move to the next problem. There is question number 4.3, right? Okay. 4.3. I think we can read the question. Take question number 4.3. Read the problem. Okay, so what is the question given here? We'll read the question once again. XY Limited manufactures two types of mobile phones, X phone and Y phone. X Limited manufacture mobile phones. Which are they? X phone and Y phone. Okay, due to severe competition, it has to reduce the prices for the next production period. Okay, the following information is provided. Current selling price is given per unit. PV ratio is available, so you can compute what is the variable cost or what is the contribution. Then product specific fixed cost is given. Then selling price per unit for the next period, that is also given. Okay, so the requirement is for the next period, the company wants to present the same PV ratio to be maintained and achieve a break even for both the products at 400 units. What is the cost reduction program envisaged? Okay, so requirement. What are the requirements for the next period? They say that the PV ratio should be equal to PV ratio of previous period. Okay, that is one requirement. Second requirement is both the products should reach the break-even point at 400 units. They should reach the break-even point at 400 units. So what should be the cost reduction program? It's a very basic level problem, nothing complicated in this. Okay, so they have given, so make it right here. X form and Y form. Okay, now what is given here is current selling price is given. Current selling price per unit is given to be 10,000 and rupees 12,000. Okay, now you can find out the PV ratio is available. PV ratio is 25% and 30%. Therefore what? The variable cost ratio. Variable cost ratio. What is the formula for variable cost ratio? It is 100% minus PV ratio. That is equal to 75% and 70%. Okay. Therefore, what is the formula for variable cost ratio? Variable cost ratio is equal to variable cost per unit divided by selling price per unit. Or variable cost per unit is equal to selling price per unit, okay, into variable cost ratio. Okay, so therefore variable cost per unit is equal to 10,000 into 75%, that is equal to 7,500, and here 12,000 into 75%, that is 70%. It is not 75%. 12,000 into 70%, that is equal to rupees 8,400. Okay, now going further, they say that the variable cost per unit for next period, okay, we can find out the variable cost for the next period. Okay, how to compute that? You know that PV ratio for next period should be how much? Should be same as previous year. So 25% and 30%. The selling price per unit for the next period is available. Am I right? Yes. Next period. Selling price per unit for next period is rupees 8,000 and rupees 9,000. Therefore, variable cost per unit is equal to selling price per unit into 100% minus PV ratio. What is 100% minus PV ratio? 100% minus PV ratio is nothing but the 100 minus PV ratio is nothing but the variable cost ratio. Okay, so this will be rupees 8,000 into 75. Here it is 9,000 into 70%. So this will be rupees 6,000, and here it will be the 6,300. It will be rupees 6,300. Okay, right. So the present variable cost is given to be 7,500 for X phone, and for Y phone it is 8,400. So this has to be reduced to 6,000 and 6,300 respectively. Therefore, cost reduction target for variable cost per unit, this will be how much? It will be 7,000 minus 6,000, that is rupees 1,500 per unit, and here it is 8,400 minus 6,300, so that is 2,100. That will give you 2,100. Now what you have to do? You have to take the cost reduction required in fixed cost. Okay, so fixed cost. Okay, now how to find out the fixed cost? You have the what all information you have. Product specific fixed cost is given. Product specific fixed cost. For current year, it is given to be how much? 10 lakh and rupees 15 lakh respectively. Is there an issue in the connectivity?